Hey there! Welcome to Forex, where we simplify finance and trading. If you're new to Forex trading and want to learn how to get started, you're in the right place. In this video, I'm going to break down the basics of Forex trading in a simple step-by-step guide. So, whether you're looking to make some extra money or become a full-time trader, stick around to learn all the essential tips you need to know. Don't forget to subscribe and hit the notification bell. Alright, let's start with the basics. Forex, or foreign exchange trading, involves buying and selling currencies in pairs. For example, EURUSD represents the euro against the US dollar. The first currency in the pair is the base currency, and the second is the quote currency. When you trade Forex, you're buying one currency and selling another simultaneously. The market is open 24 hours a day, 5 days a week, making it one of the most accessible markets globally. For example, if you think the US dollar will rise against the euro, you'd buy the USD/EUR pair. If the dollar increases in value, you can sell it back for a profit. Next, you'll need to choose a reliable Forex broker. Look for brokers that are regulated by financial authorities, offer competitive spreads, and have a user-friendly trading platform. Some popular brokers include Exness, IC Market, Pepperstone, and many others. I will be leaving a link in the description to some of the broker I use, so you can register and get started. Currencies are always represented by 3 letters, the first 2 having something to do with the name of the country, and the third designating its unit of currency. Some examples are JPY representing Japanese yen and AUD representing Australian dollar. Exchange rates are obviously quoted in pairs because you can't sell or buy one without buying or selling another. You will therefore see something like this when you go to buy or sell a currency. USD/AUD equals 1.1020. The first currency is known as the base currency and the second as the quote currency. When selling, this exchange rate tells you that you will get $1,020 Australian dollars for every $1 that is sold. If buying, this exchange rate tells you that you will need to pay $1,020 Australian dollars for every $1. So how do you make a profit from trading Forex, you ask? Well, cashing in on currency fluctuations is fairly straightforward. By buying currency when it is weak relative to your base currency and selling it when it is strong relative to your base currency, you will make a profit. Of course, it does get slightly more complicated than this, but this is the basis for making profits trading Forex. Let's say, for example, that you have $10,000 to invest into Forex. You decide that due to the theoretical strengthening economy in the UK and the high likelihood of interest rate rises to buy GBP. You buy $10,000 worth of GBP at an exchange rate of $1 to 0.6108 British pounds, therefore giving you 6,108 British pounds. Sure enough, as you anticipated, the interest rates are increased in the UK. This results in increased demand for the GBP, and it increases in value relative to the USD. You decide to buy back USD at a rate of 0.5873, giving you $10,400, a profit of $400 USD, or 4%. Before starting to trade in Forex, you should have a comprehensive understanding of a market analysis. You should adopt a multifaceted approach to market analysis rather than looking at the market from one angle. This will help ensure you make the right decisions when performing currency exchanges. You should analyze the market from a fundamental, sentimental, and technical perspective to ensure you are making the best decisions. Fundamental analysis is looking at the market using basic principles. This may include economic data, local political issues, and interest rate changes. For example, if the American economy is showing growth and promise, the USD should strengthen, and you would therefore buy it. If the interest rates in the US were about to be reduced, you may consider selling USD. A sentimental analysis will help you gauge market sentiment from buyers and sellers. After all, it is these very people that determine which way the market or currency will head by directly affecting supply and demand. The market can be bearish, investors are hesitant to buy, or bullish, investors snapping everything up rapidly, or somewhat in between. In the example given above under the fundamental analysis description, even if the economy in the US is showing promise, if the general sentiment in the market is bearish, then you are unlikely to see a significant strengthening of the USD. Negative news in a bearish market can result in amplified negative impacts on the currency in question. On the other hand, positive news in a bullish market may result in amplified positive effects, and negative news in a bullish market may not result in significant negative impact on the currency in question. The final analytical perspective that you will need to understand is technical analysis. This will include all the number crunching and chart analysis techniques that will be discussed later in this book. It is vital that you understand how to analyze a market in these three ways and apply this knowledge to each of your currency exchanges to ensure the best trades are made. Many dealers offer free demo accounts where you can trade fake money. These accounts are an invaluable tool in learning the Forex ropes, and I would strongly recommend that you trade with a demo account for a significant period of time before you start trading in Forex with real money. These demo accounts not only help you to familiarize yourself with Forex, but they will also let you know if your methods will make or lose money. You should continue to trade with a demo account until you are consistently making profits. If you have been involved in Forex in the past or done, you will hear the term pips thrown around fairly often. A pip, or percentage in point, is a small unit of currency fluctuation that we can measure profits or losses in. Most currencies are specified to 4 decimal places on the Forex, and a pip is 1/100th of a cent equivalent. For example, if the USD GBP rate changes from 0.600 to 0.5998, then the GBP has strengthened by 2 pips. Some currencies, such as the Japanese yen, are only quoted to 2 decimal places, and in this instance, a pip is 0.01. You can even sometimes hear about smaller units of change known as pipettes. Some dealers quote to 5 decimal places, and this is where the pipette term is used. 1 pipette is 1/10th of a pip. The next terminology that you will need to be familiar with is lot size. The amount of currency that you can exchange is set to predefined amounts, known as lots. A standard lot is 100,000 units of the funding currency of your Forex account. For example, a standard lot of US currency is worth 100,000 US dollars. Other lot sizes have been developed since the advent of retail Forex to make Forex more accessible. These are known as mini-lots and micro-lots. Mini-lots consist of 10,000 units of the funding currency, and micro-lots consist of 1,000 units of the funding currency. There are even some brokers that offer nano-lots, which are only 100 units of the funding currency.